Welcome in, everyone, to another episode of the Real Estate Tax Playbook, where we discuss all things real estate, providing timely and precise tax information to real estate professionals looking to build their own customized tax planning playbook. As always, I'm your host, Evan Ross, Tax Director with Brown Evans and Company, based out of our Roanoke, Virginia office locations. I'm sure most of you have had a chance to check out our website by now. If you have not, feel free to check that out at your convenience. A link to the website can be found in the description of this podcast. You'll find more information on the website about our other service lines, service providers, and office locations throughout Virginia, West Virginia, and Tennessee. For those of you watching the video on this podcast, you'll notice I'm not in my normal studio. So I'm at a different office location today. Eventually, if I use this space again, maybe I'll throw some pictures on the wall so it's not just a blank canvas behind me. But anyways, with that, I'd like to introduce our guest for today. It took a while to get him on, but we got Nathan Walker from Pinnacle Financial Partners. Nathan, thanks for being here today.
Yeah, man, looking forward to it.
Good. Yeah. I kind of alluded to it. It took us a little while to deal with some IT issues, and we finally, after a couple of weeks, we made this happen. So I'm glad we could do it.
Yeah, I'd like to say it was because I'm incredibly busy, which we are busy, but it's mainly on the IT side.
Yeah.
They got it
Well,
figured out and we're good to go.
awesome. Again, I appreciate it. I want to give you a chance to just kind of give your background, what you do for Pinnacle.
Sure. Here at Pinnacle, I'm commercial, we call them financial advisors, which is just commercial banker, relationship manager here, and got a different start than some into the banking world. A lot of people graduate college, get into banking, and think how tough their life is. But I went to grew up here in Roanoke, went to University of South Carolina, went in 2006 and decided to do corporate finance and real estate degree, which sounded amazing in 2006. At 2010, people cringed at that degree to an extent because we were right in the middle of the Great Recession. I remember having a banking class in college, and every Monday we'd come back and the professor would ask how many banks failed over the weekend. So it was pretty interesting time to be in that, learning about that and just be in the middle of that, and then getting out and working and getting a degree and working in the financial aspect side. So I was lucky to get a job with my major. I worked as a controller for a concrete construction company around here. So did that right out of college for about 6, 7 years. Got the opportunity to get into banking on the credit side, credit underwriting, credit portfolio management, and then have been on what we call the line side, on the relationship lending side for the past 3, 4 years. So I have done both operating C&I lending and also real estate, heavily involved historically in real estate, and work closely with our real estate lender here. So Pinnacle, for those who don't know, Pinnacle, we're about $120 billion bank. So not the biggest, but not the smallest, and we think can meet all the needs and are set up great to do that.
Definitely. Yeah. Thanks for the background. And obviously, we've got a good relationship with Pinnacle. We have over the years with you as well as some other folks in the Roanoke area. So I
Yeah.
appreciate the relationship we've been able to build and continue to grow.
Well, we think the same at Brown Edwards. Definitely see you guys on a regular basis with our clients, and also interact with all of you guys.
Yep. I appreciate it. You mentioned South Carolina. What drew you down there for?
Man, growing up in Roanoke, I didn't really have any desire to go to 30 minutes down the road to Virginia Tech, which great school, but just didn't really fit my bill. Figured I wanted a larger school, and USC is only about 4.5 hours away from here. So it came down to South Carolina, Hampton, Sydney, which couldn't have been two different colleges, but glad I chose the larger route, especially coming back to Roanoke area right out of college. It was nice to get away for a little bit, meet new people, and glad I did it.
Yeah. Awesome.
Wish
Yeah.
we
I
had a
think
little
the
better football.
only thing in common is maybe the colors are somewhat similar.
Yeah, I guess you do have that guarded, but yeah, I remember sitting down and having pros and cons of each. It was just like, I have no idea, especially as a 17, 18-year-old. But Hampton City's a great college, a great school too, but glad it got away.
Yeah. Awesome. Cool. Well, thanks for sharing that. So I'm sure our listeners could tell from the description of this podcast episode, but we're going to talk financing. So let's go ahead and just get into the meat of the conversation
Love
for
to.
today's episode. So what are we looking at the state of the lending market right now?
Yeah, banks are eager for growth. You talk to I've got a lot of friends in the banking world. We hear it from our higher ups, from our CEO, and banks are eager for loan growth. The vast majority of banks are public companies. We got to meet our goals and meet the analyst goals. That's not to say that you know, credit standards, I don't think are loosening or anything like that. But for quality projects, quality sponsors, you're going to be a competitive market out there. You may get a little looser structures, not from the credit side, but maybe a little longer AMs, a little better rates, things like that. But for the most part, across the board, banks are really looking to grow. A couple, 2, 3 years ago with the SVP crisis, things like that, the deposit base has shrunk some, and there's some difficulties there, but that seems to be behind us and open for business.
Yeah, I mean, that's what we see from our end too. I mean, specifically from real estate, we see it's not slowing down. It seems to be picking
Yeah.
up, if anything. You mentioned kind of credit standards are still kind of staying the same. Are banks getting a little more, I don't know, aggressive, less conservative on getting deals done to make the deals happen?
Not from the credit side, more from
Yeah.
terms that aren't gonna, that credit and repayment isn't going to be an issue. So as I mentioned, maybe spreads on the interest rates have shrunk a little bit, or amortizations have gotten potential amortizations a little bit longer. There could be some different guarantee structures and things like that that have changed a little bit. On the opposite side, I'd say that, projects are getting stress tested more in the underwriting phase. What happens if rates jump, if you're under construction and you're not in a fixed rate yet, what happens if rates increase 1 or 2% to your coverage, and lease up, what happens if you get to 80% occupancy versus 90%, or rental rates are $100 a month less than that. So, I think stress testing is a bigger thing. It's always been a bigger thing, but maybe a little bit more focus on that. And yeah, but across the board, I mean, I wouldn't say credit culture is loosening, at least not around here, or with any of the banks
Yeah.
we compete with.
Yeah. Well, from an underwriting perspective, I mean, the questions I get from underwriters that they're just wanting more and more and more information, it seems. At least the last couple of deals I've been involved in, they're wanting more and more client information
Yeah,
to help back it up. So
and that
I
might
would,
go into maybe more of their global portfolio and things like that, understanding a little bit more of when debt is coming due on those other projects, because that'll change. If they've got projects that are, or other properties that are affecting their cash flow, that are, spitting off $10,000 extra a year in cash flow, but the rate's about to double, that's going to affect how we look at that. So I could see that too. More information on it globally.
yeah, it definitely matters. And especially, I mean, locally in Roanoke, I mean, a lot of the same developers, investors, they're the ones that have their hands in a bunch of different things. So they're the ones where that debt could matter, where, hey, they may have 15, 20 projects going on. You got to kind of look at the global portfolio and not just one
Oh, yeah.
thing.
I mean, you're always going to look at the global portfolio, assuming there's recourse to the deal.
Yeah,
But yeah, I mean, it just goes into and that too depends on how the project's performing and things like that, or how you expect it to perform, how tight the numbers are.
definitely. Are you seeing that banks or Pinnacle specifically, it can be more general or specific, are favoring certain asset classes more? So multifamily
Yeah.
versus single family or commercial?
Yeah, I mean, I wouldn't say favoring more. I think, office is still a tough one, and talking about third
Yeah,
party leased office, not owner occupied. That's just continues to be a tough one. People are still trying to figure out, return to office, and changing the types of office people are going to. So that's not a non-starter, and nothing. It all depends on the project, but that's a really tough one. Hospitality, hotels, things like that are going to be sponsor by sponsor, bank by bank decision. Definitely a flagged. I mean, it's always extremely tough to get a non-flagged, and by flagged I mean, your Hyatt or something like that, versus just a randomly named hotel. It's going to be hard to get a non-flagged hotel through. That's probably going to be too. I don't know. I think you mentioned some of this. There's listeners here across the country, so that could vary where you are in region, especially on the hospitality side. Multifamily is strong. You know, there was a concentration limit, that concentrations that happened back in 22, 23. The from us, Pinnacle and your traditional bank structures, we're typically going to be on a larger project. We're going to be that construction, the semi-perm financing, and then the owner is going to take it to the perm market. So, we're going to finance the construction to this through the stabilization, and then the owners are going to take it to Fannie, Freddie, to Life Cos to get longer term permanent financing. When the rates were skyrocketing, that wasn't happening. One, because stabilization was taking longer. Two, these owners weren't going to take their 3-4% rate and refinance it for a 7% rate
Oh
just
yeah.
to get non-recourse dropped or something like that. So you didn't have that flow of projects moving out and new projects coming in. So if you think about them from a bucket standpoint, the individual concentration buckets were staying full. In that standpoint, a couple years ago, people thought banks really stopped lending because of a credit risk. It was more from a concentration risk, and the flow had just changed. So that's changed. Rates have come down some, and especially when you're dealing with swaps and things like that, it's making sense for these larger projects that have become stabilized to move out. So yeah, and industrial is always a hot one. I mean, I don't think any bank is going to say no to quality industrial projects just because they're so limited from zoning that those lease up tomorrow. So yeah, again, office probably is a tough one, but outside of that, that's the toughest.
I agree. I mean, that's what I see. That's what I'm seeing a lot of it from my space. A lot of industrial, a lot of multifamily apartment complexes, things of that nature. And then maybe not Roanoke specifically, but on a more macro level, they're at more hospitality in your bigger markets. So
Yeah.
Roanoke's a little bit different in that sense in that industry. Now you mentioned kind of new construction and interest rates. What are you seeing with interest rates? Are those kind of stabilized at this point? I know there was a drop kind of in into 25, but where are we at now?
Yeah, it seems like the last year or two, they may change 50 basis points, something like that, but nothing significantly. Your term debt is usually going to be priced on a spread over the treasury. So you got a 5-year term, you're going to be somewhere between 250 to 300 over that 5-year treasury. I think yesterday treasury was about 5-year was 260, 265, something like that. So I'm sorry, 360, 365. So you're looking at a low to mid sixes on that, which has been pretty much, we've been under 7 for a while now. Again, that change, a smaller deal might be above 7. A large, brand new, very competitive deal might be closer to 6. You could get maybe below 6 on some swaps or things like that. But yeah, I mean, they've stabilized. I don't think people aren't not doing things because of interest rates anymore,
Yeah.
or waiting. I think couple years, I think people were waiting a little bit just because they're like, well, in 6 months it could drop by 2%, which that's not gonna happen unless if that happens, we might be in where there's gonna be a bigger difficulty than or
Yeah,
issue
we're gonna
than
have more we're gonna have more
yeah,
economic
yeah.
problems than
I'll say interest rates though still at that 6 or so. When interest rates were 2.5, 3.5% in that 2021, 22 timeframe. Proceeds for loans were really just limited by LTV. I mean, everything was hitting the debt service coverage. Anymore with the rates, the debt service coverage is really the one that's limiting the proceeds versus the LTV. They are from that sense have an effect on the cash flow. So sometimes borrowers are having to put in a little bit more money or things like that, a little bit more equity into the deal. But I don't think it's stopping anybody from doing projects.
yeah, I would agree. I don't think so either. I do think a couple years ago, 2, 3 years ago, when things started to peak, I think people were a little bit more like, oh, well, maybe it's going to go down because they had just recently seen those rates 2.5, 3, three and a
Yeah.
half at that period. So I think it was kind of fresh in people's minds. So they were maybe hopeful and holding out. But I think now it's been a long enough period of time that you can only wait so long if you're going to
Yeah, I
stay in
mean,
the
what's that
game.
0.5% is not gonna if that's busting your deal, that's a pretty risky deal to begin with.
Yeah, you may need to rethink
Yeah.
the project in the first place. So
Yeah, for sure.
cool. Well, yeah. Well, thanks for sharing that on the interest rates and where we are from that standpoint and what you're seeing. Let's go back. Let's kind of talk a little bit about loan structuring. And you mentioned the underwriting process kind of early on, but a lot of our listeners, some people they've been doing this for a long time. They know the deal when they go in, when they're getting loans. What would the starting process look like? You don't need to simplify it
Yeah.
that much, but what would it look like for a new investor looking to get financing?
Yeah. I mean, hopefully there's a discussion at first between myself or the potential banker and the customer. The first thing is know your customer. So if you're just out there calling random people and saying, "Hey, what's the best rate you can do?" You're probably not going to get the best rate that they can do. You know, once we get some numbers from the potential customer and deal specific, there's probably going to be either some high level terms or you get to more of a term sheet. And one thing I would say on a term sheet is that if you get a term sheet from a banker, I would say, who approved this? Because the term sheet's not going to be anything guaranteed. However, you do want it run by the final approver. And sometimes bankers say, well, it's fine, I got it. But still, if I'm deciding on a project, if I'm the customer, I'm going to want to know that the final approver saw this. Things could change, but from a term sheet, if it's been blessed, unless something significant changes on the project, it shouldn't change too much. Then once that's approved, we're going to once that's accepted by the bar, we're going to go to, get final approval. You're going to have to get the appraisals. You're going to have to get, depending on the size of the project, environmental. So that further due diligence phase between kind of all right, let's move forward with this deal to closing is going to be very project specific. If it's construction, that's going to be getting all the due diligence with that, with reviewing the contract, reviewing the budget, things like that. Versus if it's just a duplex loan, it's just probably getting the appraisal and getting loan docs together and some small environmental flooding, stuff like that.
Thanks for sharing that. And what kind of metrics or information are you pulling from the customer? So they're coming
Yeah.
in, they have this project in mind, you're kind of getting things moving. What are you looking at?
Yeah.
Financials, tax returns? What's that look like?
Yeah, again, that is very project specific. I would say, first off, do as much as you can to not let the bank and underwriters decide on what the facts of the project are. So give as much information because we're just going to go conservative, right? When you're talking about the project specific, provide what the rents are, or if it's construction, or if you're changing it, what are they going to be in the future? And provide what expenses you think they're going to be, or we're just going to throw all the expenses we can on there. Well, not all, but we're going to go conservative. And I'm not saying we're going to not use some of our own, but at least we're going to use what we get from the bar as a starting point. And then you've got your personal guarantor stuff. So, yeah, have your couple years worth of tax returns for all of the beneficial owners that are going to be guaranteeing the deal. You're going to provide your personal financial statement, which is going to, list all your assets, all your liabilities on there. That doesn't need to be as of yesterday, but I would say within the last 6 months or, update that every 6 to 12. Definitely every 12 months. Every 6 months is probably better. And then anytime there's like a significant windfall of you sold a property and got a lot of liquidity. If you're a borrower that has a fair amount or any other investment real estate, you're going to have provide your real estate schedule, your REO, real estate owned schedule. So have that as detailed as possible to have locations, property type, when the debt is coming due, what the debt payments are, what maybe last year's NOI was, so we can get a good global on there. If your stuff is held in multiple businesses that are filing different tax returns, you're gonna have those business tax returns also. But you know what? And then on that, one thing I was thinking about when we were leading up to this is what we look for from a guarantor standpoint. I mean, the first is liquidity. We want to know in this how can your resources help repay this loan if something happens. And then on the PFS specifically, break out if you're married, break out individual versus jointly held assets is important. A lot of people don't do that. It's not necessary, but it makes you look more of a sophisticated that you've done this before because we can't rely on a jointly held investment account with your wife to help repay that loan and to go assets we can go after if we need to.
Makes perfect sense. Are you seeing a serpent? Well, I get every project's different, as we know. I mean, it depends if it's construction or you mentioned a duplex or smaller projects or
Yeah.
stuff like that. Are you seeing more of a certain type of structuring with the loans, as in traditional loans, bridge loans? You mentioned swaps earlier. Are you seeing more of one than the other?
Yeah, I mean, we're not gonna be dealing with bridge loans.
Okay.
Maybe we're taking over, maybe a deal had used a borrower had used a bridge loan to get something done, and now it's ready for more traditional financing. Our financing is gonna be, our borrow equity and our loan. We're not gonna have typically not gonna have seconds on anything behind us.
Okay.
And the problem with a couple things run into that. I mean, that kind of speaks to the strength of the guarantor if they're having to rely on a bridge loan or a second, but also that's going to affect the cash flow and make it hard to meet the debt service coverage because we're going to take that into account on the property cash flow.
What's the approval process look like for you all timeline wise? Do y'all have like an average, or does it really just depend on how quickly the client gets you information? How
Well,
same thing we deal with, but
yeah, yeah. Yeah. I mean, one obviously is going to depend on timeliness of getting information. Two, that's going to go back to that property specific. If it's a straightforward um, purchase or refinance of an existing property that's stabilized, you can 30, 45 days max probably. If you're talking something that's including SBA loans, if you're talking about something that is construction where then maybe there's a phase one and a phase two. If it's a large deal and you're having to get attorney prepared docs, I mean, you could be talking 2, 3, 4, 5 months. So that I would say straightforward deal, 30, 45 days, assuming everything goes smoothly. Not straightforward deal, more to for due diligence, 3, 4, 5 months. But the thing is most of the stuff we're talking about in due diligence is not the bank. How long the appraisal time's gotten better. At one point, it was pretty long. Environmentals can take longer. That's third party. Title insurance, title searches, that's third party. Things like that are really not up to the bank or unfortunately up to how the bar can help with that. Yeah, I mean, obviously it's easy to say, but the earlier we get involved, the better.
yeah, I definitely agree. Yeah, we've had some other conversations. You mentioned title and settlement. We've had a podcast episode previously with Jerry Donovan with Covenant. He spoke on that piece. We do need to get someone here from the appraisal perspective to kind of speak on that process and what it
Yeah.
looks like.
Yes, but one important thing that I think it's becoming well known, but still some people um, don't understand or money can be wasted on the front end is the bank has to order the appraisal. The borrower cannot order the appraisal. The borrower can't order an appraisal and the bank takes it over. That changed in the 2006, 2008, whatever, all that the federal laws enacted. My dad was in real estate and he tells me he used to be able to call up the appraisal and choose which appraiser he wanted. We as bankers don't even. It's a third party. I mean, it's within our bank, but we don't even see when we order appraisals, it just comes back. Appraiser A says it's going to be this much and this turnaround time. I mean, I don't know who the appraiser is or anything
Oh
like that.
wow! I don't know if I realized the bank. I knew the bank had to order it, but I didn't realize. So there's no say. So if a customer would like to use someone, you can't put. I mean, well, obviously, that kind of cheats the game a little bit
Yeah.
because if you know the appraiser, there's a chance that they're going to fudge it a little bit.
Yeah,
Not that they would,
they've
but
taken all of that out of it.
yeah,
The appraiser has to be on the bank's list.
it is someone at least local, I guess.
Not always, usually.
Okay.
I mean, if it's a small, usually it's going to be, and especially if it's a smaller project, it's going to be. If you're getting into, more unique projects or a project of a significant size where it would make sense from a appraiser from Charlotte to come up potentially, or if they get, there was one point when rates were low and they were just getting bombarded with appraisal requests. Appraisers were turning stuff down. They just weren't responding to the bids.
Wow.
So yeah, I mean, the one thing we can do, if you get down the path with the bank, and I mentioned a term sheet being approved by the final credit approver, if something changes and they it's not going to work out, so now you're going to go towards it with a different bank. There are instances where we can take if that former appraisal bank has already had ordered the appraisal or received it, there are times when we can use that one. We wouldn't necessarily have to order a new one. But sometimes when a customer has already ordered an appraiser to figure out the value or something like that, when they're buying it from maybe they're leasing it already and they go to buy it, or they're buying one of their partners out or something like that. and they wanna get a new loan and they get an appraisal for that, we can't use it.
Yeah. So yeah, I mean, like you said, it's kind of a waste of funds to an
I mean,
extent.
they're not.
If you're trying to do it for the loan purposes, it's kind of a waste in that scenario. There's other reasons you could get an
Yeah,
appraisal outside
yeah.
of lending, but yeah, I appreciate you mentioning that because I don't even know that I, to the full extent, realized how that process worked and how the appraisal was ordered.
Yeah, it's a pretty, it's pretty cut and dry and very separated part, and a lot and some even some smaller banks just use total outside third party groups to even order the appraisals.
Okay. Good to know. We mentioned new construction a few times. I guess in a situation where there's new construction and there's overages and just running out of funds based on the original lending. What does that look like when that customer comes to you and says we need more? Is that a
Mm.
I'm sure it happens a lot or
Well,
occasionally.
hopefully it's not at the last dollar that's in the in the
Yeah, you hope you're ahead of it and you can see where it's trending that
yeah,
that there's going to be some overages because I mean that
and
does happen a
and
lot with construction.
yeah, I mean that. Let's be honest. I don't think there's rarely ever a project that is under budget anytime.
If
And
so, I'd like to
we've
meet
all
that
done home
developer.
renovations and building. I mean, and stuff changes, and there's change orders for
Yeah.
stuff added. There's change orders for all sorts of stuff. I mean, the first part is going to be you're typically going to have a 5-10% contingency built into that budget where there can be some of those changes. Um, we are looking at, a construction project. How that goes is, the customer is giving us, or the clients giving us monthly draws, and so we're putting that against their, in a spreadsheet and keeping track of where are they over, where are they under on AIA is pretty easy to tell and things like that. There's two options if you get to it and it's like you're halfway through and you see that, this happened a couple years ago when wood prices, was skyrocketing or steel skyrockets
Yeah.
and things like that. I mean, you either put more money in as the borrower or you increase the loan proceeds. Typically,
Or I guess option 3, the project goes on hold, which I saw some of that during that time frame where costs
yeah,
were
I
getting
mean,
not a
yeah,
lot, but I did see it.
hold during the project's going to be kind of tough, I would think, but
Yeah.
that could definitely happen. The issue you have with additional loan proceeds is probably gonna have to get all new loan docs. You're gonna have to get all new, probably have to get new appraisal. You're gonna have to get or updated appraisal. So there's a lot more than just saying, okay, we'll give you another 500,000 or something like that. But yeah, I mean, it happens. I would just say, the sooner the better. Just like if you've got a project that's, just not stable. It's not leasing up like you expected it to, and you're not going to hit that covenant at the end of the year that you're going to. Talk to the bank ahead of time. It's a partnership. Yeah, our money's out there just like your money is out there with the equity, and we want to get repaid just like you guys want the project to go well. You don't want it to be last minute. Oh, you know, we're over budget or last minute. This project isn't working out.
I agree. I mean, I think that's in any walk of life, but I mean, in our world too. I mean, the sooner you get ahead of something, the more adequate you're going to be equipped to make changes and to pivot if you need to.
Yeah, and I'd say too. I mean, we're not old guys. Most lenders want repeat customers. If you things happen. I mean, it's not a perfect world. Real estate's not perfect. C&I biz operating companies aren't perfect. But if you one coming early shows us that you know what you're doing. You're on top of your project. So that speaks for future projects. And so I mean, yeah, I mean, I can't stress that enough. Is the sooner than better. And don't change the property type without telling us. Don't do a new build and then go for sale project and start renting it and
Yeah.
not tell the bank.
Yeah,
One,
you
that's
run into some
gonna
bigger
be
problems
against your
there,
loan docs
and there's
and
probably some zoning issues potentially too, depending on who they're
yeah.
if they've gone through that process yet or
Yeah.
not. So,
Mhm.
anyways, well, I mean, we went over a lot of different information today. I think it was quality information. Do you see the trends we're going? So the market, I mean, you all are open for business. People are coming for loans to get lending for projects. Do you see that continuing? Do you see anything, regulations or anything that's going to hold that up in the near future?
No, I mean, I think, uh, housing is always gonna I mean, that's clearly an issue all the way to the top of the government. it's not changing anytime soon, the lack of housing. So I don't think that trend is changing. We haven't really touched on, we've been talking about more investment, haven't touched on like home building. There's a fair amount of home building going on, new home building around here, and I would assume across everywhere. No, I don't think that's going to change anytime soon. Are there times where maybe the government's gonna put some money in, kind of like, historic tax credits really help downtowns. Is there a way to help with new home builds from that end? Maybe, but I don't see that stopping anytime soon. Um,
I
the
completely
office
agree.
could change, and hospitality could change. But no, I mean, I think trends are going to continue. Things are going to roll. Hopefully, rates drop a little bit. That could only help boost demand even more than what it is now.
Yeah, I completely agree. Well, I appreciate you taking the time, Nathan, to come on and talk through some of the financing and lending aspects. I mean,
Yeah.
you could go on and on, I think, talking about this. There's a bunch of nuances that folks probably need to know about. So if people are interested in following up with you or have questions, whether it be for lending or just other items, how can they get in touch with you?
Yeah, the easiest, just shoot me an email, nathan.walker@pnfp.com. Always happy to chat, answer any questions. It could be something that we're never gonna help with, but love talking about real estate, love talking about banking, operating side, real estate side. Happy to chat and give my advice where I can.
Awesome. Well, hey, I really appreciate you coming on today. That is a wrap for this episode of the Real Estate Tax Playbook. Those of you who've been listening for a while, appreciate your viewership and listening. Feel free to share with friends, colleagues, family. You can download the podcast wherever you get your podcast, Apple Podcasts, Spotify, YouTube, if you want to see mine and Nathan's face. You can also listen to the audio in your car or while you're walking the dogs, going for a walk. So again, I appreciate you listening today. Nathan, I appreciate you being here. We'll be back next month with another episode.